Riaz Capital coming up next. They do workforce housing in the Oakland and surrounding areas. I'm going to bring Mathew Salter up on stage right now.
Well, thank you everyone for participating in WealthChannel's Alt Expo. We've been here before. Over the past couple of years, we've had some opportunity zone funds that we've raised, and we've really enjoyed getting to know Jimmy and Michael and the team, and glad to be presenting today in front of all of you. As Jimmy mentioned, we are a Bay Area focused development and asset management company, and we're really focused on the workforce part of the market in multifamily. Our latest fund that I wanted to talk about today is our distressed value add opportunities fund. We're just launching it, it's brand new, but it really is the fifth fund that we've raised. So we've had a lot of experience in doing this, and we're excited to bring this to the market. Just a fund overview quickly, $100 million target equity raise. We're looking at a 1.5 to 2.5 times target equity multiple, which the 100 million will translate into 250 to 300 million of stabilized costs. The IRR range here is 12 to 20%, and I'll get into why that is a larger range. And we're looking at a 9-year hold. This is a value add real estate strategy, and what we're looking for the value creation part of what we're going to bring here is about 40% of the value will be created through just traditional building operations and infrastructure improvements. And then 40% will be this additional density that we plan to build into the buildings, which we think is a sort of differentiator for us versus other managers in this category. And then 20% will come from improved energy efficiency and upgrades that I'll get into. Just getting a little bit into a little bit of information about us. We're about 25 real estate professionals and about 30 administrative, so about a 50-person, 55-person team. We have $750 million of real estate under management, and we have about 3,000 units under management and development, which is about 57 buildings. And across our portfolio exits, we've achieved a 30% IRR. Most of those exits have been value add, which is part of the reason why we're launching this strategy, and about $130 million of value created in 10 years. The key principles of the firm, there are 4 partners, Riaz, Max, Seth, and Paul. Riaz has 20 years real estate experience and comes from a real estate family, really deep roots in the Bay Area. And then underneath the 4 partners, we have several vice president, lieutenants leading all areas of development, legal, design, and operations. Just kind of taking a little bit of a deeper dive into our portfolio. We have 38 buildings that are core and stabilized, cash flowing, and we have investors that have come into all of those. And most of that portfolio has come through the years through our value add process. So if you look right now, there's 3 buildings that we're currently doing value add. And in those deals, we have in the past syndicated them on a deal by deal basis. Once those deals have stabilized, they move into our core portfolio. Many of our investors are high net worth. They're not looking for exits. They tend to want to hold on and cash flow these and not realize the capital gains. Or we've had 1031 exchanges into these different deals. So the same principles will apply here with this fund. We can accommodate 1031 exchanges. We offer a lot of flexibility on the exit for those investors that would like to stay in the fund past its liquidation, because a lot of the people, like I said, want to stay in our core stabilized platform and not realize the gains and realize the cash flow over long periods of time. The last area is this development part of our portfolio, which is really raised over the last 3 or 4 years through our development of Ozone Fund ground up developments here in the East Bay. And those are ongoing projects, but they're separate lines of business from the ground up development to our value add portfolio. And then just a little bit of history about the firm. Riaz's father really started it. His name's Russ Taplin back in the 70s. And in the first sort of area of, having gone through so many different real estate cycles since those years has really informed this sort of cycle resistant ethos to the firm, that we want to create portfolios of real estate that can sustain through different business cycles. And those values have been informed by this 40-year timeline of history. First, about creating value in the 70s, which was really about condo conversions in the San Francisco Bay Area. And then from the 1989 Loma Prieta quake, where the Taplin family lost several buildings, was really creating a diversified portfolio so no one building could take the portfolio down. 2001 through 2007 was really when Riaz came into the picture and did a lot of high-end design and flip homes in San Francisco, and learned to kind of hone his design aesthetic, which you'll see in all of our buildings. And 2008-15 was really building out a core value of stable cash flows from our portfolio. And then the last sort of the development funds is really talking about how do we service an underserved customer, which we target really the moderate income demographic that has just, there's been no housing built for that demographic specifically. So that just leads me into our company strategy. Our value proposition is simple. We focus on these Class C apartments. Many real estate developers are focused in the Class A, Class B, new construction, lots of amenities. We look for these older buildings that have just not really been given love or attention. And we've found that by improving those buildings, by creating a positive resident experience, thinking differently on our design principles, and really having equitable and desirable housing, that this is an area that's ripe for returns for investors, but also for our customers to really experience a positive experience in their living environment. Just a little bit about the philosophy. We create value in everything we do. We believe all real estate is local, and that we really invest in markets that we know well or have good partnership relationships in. We underwrite with downside protection. We stress test our assumptions. We maintain financing flexibility, which includes having lower leverage than I think our competitors across our portfolio. I think the loan to values in the 50 to 60 at the high end range, so that we, when we have down cycles, we're never forced sellers. And then on the execution and vision side, we build efficiently and quickly. We leverage as much state California density legislation as we can to be able to entitle and build our buildings quickly and move over local opposition. And we build with impact. We think doing good is a core fundamental part of our company culture, and all of our buildings are built with impact in mind, which includes increased density per square foot, transit-oriented, and green construction. Just talking about our process for a minute, our value add process is we start by identifying the opportunity. We find areas that align with our densification strategy, underserved demographic, attractive basis in the building that we're acquiring, lack of affordable housing options, and qualifies for some sort of beneficial treatment through housing law utilization. We select the best site once we've identified that opportunity, and we look for characteristics: access to mass transit, entertainment and recreational options in the neighborhood, and then within the radius of large employer base. We then improve the operations and infrastructure, welcoming lobbies, a really nice sense of arrival, bike storage, and then tech-enabled entry and package storage. So all of our buildings are really tech forward. And then on the impact side, it's really these two areas that this fund will focus on and what we focus on as a firm. It's increasing the density. We're looking for every nook and cranny where we can add ADUs or smaller format housing that have been overlooked, so that we can increase sort of the ROI on the building. And then we look to improve the energy efficiency by either installing solar or increasing the electrification of the appliances and the units themselves. In terms of why Riaz Capital, what's different about us as a manager and what's our edge? It really is on the ingenuity side and the impact side. Ingenuity wise, it's about design optimization. Our units in Oakland tend to rent for $6 per square foot versus the Oakland average of $3. And we do that by just maximizing the square footage of our buildings. The construction expertise. A lot of people in this space, they outsource their construction, or they don't, it's not a core competency. Since we build from the ground up in our development strategies, we have in person in the company capabilities to build or take over projects wherever we have to. And so that sort of expertise lives in the firm, and it impacts all areas. And that's how we've sort of created this small format housing. The streamlined marketing and operations, we're really creating a brand here. We call it Art House, where we can direct traffic and we can create a sort of portfolio approach where people feel a sense of affinity for our brand and what it means in terms of a living experience and access to desirable neighborhoods, a look and feel that's different than many other of the options that are available. And then on that operations side, really having online leasing platforms, virtual tours. We use AI for some of our property management and maintenance. We really forward thinking in terms of the tech and tools which add ROI to the bottom line. On the impact side, it's really taking advantage of housing legislation. We've uncovered, the state density bonus, the ADU laws. We spent a lot of time uncovering those legislative impacts so that we can drive more quicker entitlement timelines and more units in our buildings. And then on the federal incentive programs, the Inflation Reduction Act is, providing a maximum of $14,000 per unit for rebates and energy upgrades that we plan to take advantage of in this fund. And then the last part is the reduced cost of capital. Because we're sort of mission related and our target demographic is moderate to low income, we qualify for discounts on financing, which I'm sure many of you are worried about in this environment with real estate. The fact that we qualify for mission financing lowers our cost of capital and extends our amortization period. And then, we see value where others don't. I think this is a value strategy at core. We find diamonds in the rough to extract value. One of our projects on adaptive reuse was a dilapidated church that we turned into beautiful and attainable housing. And then our current company headquarters is located in, an old cannery that was, urban blight, was sitting here at vacant for years and years, and we've turned it into a vibrant community that houses 100 businesses in the area. Just when thinking about how would this fit in your portfolio, we're focused on the mid-market, so $10 to $100 million size deals. We think that there's a lot of, it's very fragmented. We think there's a lot of alpha opportunities. And it also is more of a diversified strategy because we'll have a little bit smaller deals that we're working on. So the portfolio will be 10 to 15 buildings versus another fund that, is focused on 1 or 2 buildings. It helps diversify the risk. And then here is the track record. Over time, obviously, you guys will have access to the presentation, but we've sold a lot of buildings since 2013 and realized a 2.9 equity multiple on those exits and about a 30% IRR. Okay, just shifting gears to the market opportunity, we see that there's a compelling opportunity to add value because of the high interest rates. Asset values are falling, and which is creating more distressed opportunities in the market. And we think that will play out over the 9 years ahead in this fund, and that we can take advantage of the Inflation Reduction Act and housing legislation to add, are going to add more value to this fund because of these sort of housing legislation. Which takes me to this sort of slide, this RENA, which many of you who aren't in California wouldn't understand, but the state sets these targets that every single municipality has to meet. And the state of California is forced to build 2.5 million housing units over the next 8 years. And 421,000 of those units fit in our demographic, which is moderate income. In the past, we've taken advantage of opportunity zones and the ADU and density legislations. And lastly, this IRA, with the $369 billion that the federal government's pushing in this direction, is really the right place at the right time. So our value add toolkit is really densifying, modernizing, electrifying, and then financing. And the implementation is, like I said before, about the process, selecting the best site, improving the operations, adding density, and then adding the energy improvements. And here's just sort of a look of kind of the beautiful aesthetic that we provide to our buildings. We really have a unique point of view that adds a lot to our resident experience that's different in this category. In terms of site selection, we are Bay Area focused, but our farthest property right now is in San Diego. So we think this will be a more California focused fund because we take advantage of the state density bonus and ADU laws that are endemic in the state. And then I am going to skip through to really show you the density part, which is really important in this fund. So this is a real life example of one of our projects right now at Oakbrook Manor in Oakland, where we've taken 2 garages and converted into a junior 1-bedroom suite for 400 square feet. And this is what we added 17 units to this building in this manner because we're 17 garages on the outside that we can utilize. A second example of this is a sort of 2-bedroom townhouse that we've converted to 3 units. And then a third example is here, 220 Grand, also an Oakland property where we subdivided a large 2-bedroom flat into 4 units. So that's really our kind of edge and expertise, is taking larger formats and converting them into smaller footprint housing. And last, we look for buildings that have detached garages that we can convert into townhomes. On the Inflation Reduction Act side, we can, like I mentioned before, there's about $14,000 per unit available to offset construction costs to improve these units. And then on the solar side, the Inflation Reduction Act has kind of increased sort of the subsidies and rebates and tax credits from what was in the past 26% to offset those costs to 50% in low income neighborhoods. So we see a really big advantage of adding solar to all of our properties. And now I'm just going to turn to kind of just explain to you the math behind the strategy. What we're looking to do at the end of the day is to raise the cap rate from our purchase to when we've completed the value add additions. So in this example, which is this is a sample deal, but it's based on one of our properties in Fremont, we acquired the building for $15.3 million, and it had roughly $1 million of NOI, which was a cap rate of 6%. Through our value add activities, we were able, for $5.5 million, we were able to increase the NOI to about $700,000 from that. And the ROI on those activities is about 12.5%. So when you combine what we did to the base building, we end up with a cap rate of 7.7%. And that is the lift that we're providing. That doesn't require cap rate compression. We're not talking about the exit of the building. We're just talking about the value add that we can bring. And so we believe no matter what happens in the market, by lifting that cap rate from 6 to 7.7%, we will make money. And we will be able to figure, if cap rates compress and the market improves in real estate, that will add even more to the exit opportunity. But just the base value, if we're able to bring the cap rate up to 7.7% and yield that on the real estate, that's a great return for our investors. And what creates that value is the renovation, the densification, adding the units, that electrification, and then sort of the offsets from the credits and rebates we can get from the Inflation Reduction Act. And here's sort of a waterfall of those activities showing you how we get from 6 to 7.7%. So lastly, I'll just touch on the sort of summary of the key terms of the fund. Our target equity raises $100 million. The minimum commitment's $250,000. The term is 9 years with 2 one-year extension options. Target return 12 to 20% net IRR to investors, which is a 1.5 to 2.5 times equity multiple. The average cash on cash return or yield, we're targeting about a 6% yield after the investment period, which would be 2 to 3 years. And then the fees are 2% asset management fee on effective gross income, so not on the equity or the total stable cost, it's based on the gross revenue. And then we have additional fees at the property and project level that include the construction costs and financing costs. In terms of the waterfall, the standard fee levels at a 75%, 25% split. And tier 1 is that 100% goes back to investors till you get your capital back. Tier 2 is that you have an 8% preferred return on your capital contributions. Tier 3 is that the GP receives 25% of until we receive our 25% of the distributions. And then the last tier is that split, the 75-25 between the GP and the LP. And just looking at sort of the range of outcomes here, because obviously a lot's happening in the real estate markets, we're really looking at these sort of assumptions here in the middle, which is looking at the current market. And then some of the assumptions we've changed are that you're looking at is whether the rent growth goes up or what's going on with inflation to sort of change the parameters of what could happen. But if all goes well, which happened in our past fund, if we get a market recovery and rent growth, that's where we get the high 20s% IRR. And then you can see, like, in the current market conditions, we would expect a net IRR in the 12.5% range. The last slide that I would show is that we are offering discounts for early investors. So you're able to achieve the next tier. These are sort of how much you invest. And if you invest before June 30th of next year, you will achieve the $1 million level at the $250,000 level as an early investor. And we're requiring everybody to, in the quarter they invest, to invest 10% of their commitment amount prior to June 30th. And then the capital will be called as we do the projects.
Awesome. Matt, thank you so much for presenting today. Thank you to Riaz Capital for sponsoring Alts Expo here at Wealth Channel. We have a bunch of people just joining because I know you're eager to hear from. We have the Queen of Alts, Shayna Sissel, waiting in the wings. She's going to present portfolio construction with alternative investments. I do want to give Matt just another minute, though, because we're running a minute or two behind here. Just to get you a couple of questions, Matt. One of our attendees asked, can you do a 1031 exchange into any of your funds?
Yes. So we are providing that flexibility on a one-off basis, but yes.
Good. So get in touch with Matt and his team at Riaz Capital. The email address is on the screen there. You can reach out to investors@riazinc.com. Matt, we're at time. I'm going to cut you loose and bring our next presenter on stage, but thank you so much for joining today. Really appreciate it.
Thanks for having us.